Thanks for tuning in to our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, starting out with our chart of the week, this one we're calling long-term oil tracking US break-even costs. And one of the things that I find interesting is we've had this spike in oil prices with the Iranian conflict. But when we look longer out at the futures curve, the 5-year futures price for oil hasn't really budged despite this conflict. And then when we plot out the break-even cost for US producers, you can see that there's a really tight relationship where the 5-year futures price on oil seems to be really anchored to the break-even cost for US producers, which makes sense as the US is now the largest producer of oil on the global market. That's going to be kind of the magnet for long-term oil prices. So for us, it's not really much of a question on if oil prices revert back towards this longer term break even cost for US providers. Maybe the question is more so when will they do so? How long will it take oil to normalize back to these levels? And that'll have to do with the duration of the conflict and how much damage is inflicted on energy infrastructure. But long term, I think the expectation should be that oil is going to track really that marginal cost for U.S. producers, given the U.S.'s size in the global oil markets now. Now, when we think about inflation, it is likely that we'll get a little bit of an inflation impulse here from higher gasoline prices, higher food prices. But even before the Iranian conflict, last week we got an update on producer price index here for February. And we can see that's that dashed black line. We can see that it turned higher in February, and it is pretty stubbornly above the 2% level we'd be looking for to meet Fed targets on inflation. And what that tells us is even before the Iranian conflict, there was some pressure in the pipeline for inflation. And, these correlate really highly with each other. The blue line is consumer prices, what you and I feel every day. And there is a high correlation there. So I would expect that some of this pipeline inflation pressure that we even had seen in February will start to make its way into consumer prices and put a little bit of upward pressure on inflation. And that's likely why the Fed is holding on their rate cuts right now, is that there is still some inflation left to battle with. And what is important is not necessarily inflation itself, because inflation's at levels that historically haven't been much of a problem for either the economy or the markets. Yes, it's higher than what the Fed wants to see, but 2.5% to 3% inflation levels is about historically the average that we get for inflation. What we really want to watch is the impact on consumer sentiment. We can see here in orange, this is the University of Michigan Consumer Sentiment Index, and consumer sentiment is already pretty depressed. I mean, it's actually about as low as it gets in non-recessionary environments or even in recessionary environments. And as a matter of fact, consumer sentiment, this is a simple indicator from Ned Davis Research. Consumer sentiment had dropped to a level that was in line with historically very little economic growth. In fact, the economy's only grown 0.1% per annum when consumer sentiment had fallen that much. Now, lately, we've seen consumer sentiment trying to bounce off of its bottom, but if you get an inflation impulse here, it's questionable how consumers are going to react to that, especially because when we compare the environment today to back in 2022 when we had the last inflationary impulse, the consumer had much more in the way of pandemic savings from the stimulus programs that were launched, and the job market was much different. It was a much hotter job market back in 2022. We don't have as much in pandemic savings anymore, and the job market is softer. So we need to keep an eye here on consumer sentiment and see how that progresses here through the conflict. Now, midterm years have been a challenge, quite frankly. And this chart shows the average midterm year cycle based on different scenarios. And that orange line is all second term Republicans. And you can see that the second term Republicans, you get some weakness in the midterm year cycle into about October or so. So it's been our expectation this year that we were going to have more volatility. We were going to have challenges of a midterm year. We didn't know exactly what those challenges would be. It is looking like the challenge for this midterm year is around higher energy prices, and that's kind of what's squeezing the consumer. And when we think about rising gas prices and its impact on the market itself, we can see that even though the economy has gotten much less energy intensive through time, the relationship of gasoline prices to the stock market has remained fairly robust, where rising gasoline prices, especially if they rise a lot over the last year, and we can see here that gas prices are up about 36% over the last year. And that's historically been a headwind for the market. The market's actually had negative returns historically when gas prices have risen this far, this fast. So that is something to watch. Higher gas prices are a headwind, like I said, on the consumer, on the economy, on profit margins, and on the stock market itself. Now, beyond 2026, one of the things that we're really keyed into right now is in potential shifts of the secular environment. So, oftentimes, what we're talking about in this webcast is cyclical trends. So, trends that last for maybe a couple months to maybe just a couple years. But secular trends are these really long, like decade-long type cycles that you can see in stocks, bonds, commodities, and other asset classes. And so, what we're showing in this chart here in the top are all the secular cycles. The blue shading is the bull markets, and the orange shading is bear markets. These are the long-term secular cycles in stocks going all the way back to like 1900. And then the middle clip is showing interest rates and their secular cycles through time. And then the bottom clip is showing commodities. And one of the things that jumps out to me when I look at this chart is commodities and stocks tend to run, it almost looks like a checkerboard pattern where if commodities are in a long-term bull market, stocks are typically in a long-term bear market and vice versa. And what's interesting about that is commodities really since the pandemic have started to really catch a bid, and it's starting to look like a secular uptrend in commodity prices here. And if that were to be the case, if commodities do launch into a 10 plus year secular bull market, I would suspect that that is going to be a challenge for the stock market in the next 10 years or so too. So we do think that the secular bull market in stocks is at least long in the tooth. I don't know exactly what inning it is in, but it's probably not early innings here. And we want to watch for shifts in secular trends. Now, another thing that we would expect if we were in a more secularly challenging environment for stocks is that US stocks tend to underperform international stocks when there's been a secularly difficult environment. So, this chart here on the bottom clip is just showing US stocks relative to the entire globe, which is 50% US as well, but the US stocks relative to the entire globe. And you can see in the green shading, those are secular bull markets and stocks. And we can see that the US has tended to be a pretty strong outperformer in those environments and has been an underperformer in secular bear markets. So, one of our expectations would be if it's a more challenging environment for large cap US stocks, is that international stocks could perform better through that environment. The other area that we're interested is down the cap specter in the US. So here we're showing the US market. We're showing what percent of market cap is in each sector for large caps, mid caps, and small caps. And you can see that large cap stocks are just dominated really by technology and some other growth areas, but mainly technology stocks. Whereas mid cap and small cap stocks have a little more of the commodity complex embedded, a little more old economy type things, the industrials, for instance, are in there, and they tend to be a lot more value than growth in their makeup. So if you do get this secular shift of commodities performing better, large cap US stocks performing a little bit weaker over the next 10 plus years, you may want to look at more undervalued places in the value areas. And you just have more of that in the mid cap and small cap spaces. So that's what we have for you today. Our closing thoughts on everything is that the U.S. is the largest producer of oil for now, so it should make sense that that long-term oil prices are going to track those U.S. break evens, what it costs for us to drill a new well. And so it may not be a question here on if oil prices revert, but when do they start to revert? Now, there was some pipeline inflationary pressure back in February before the Iranian conflict. So we want to watch the degree that producer prices work their way into consumer inflation in upcoming months. And that's important because consumer sentiment might be a little more fragile here as consumers are not quite as buffered against inflation as they were in 2022. Now, the 2026 midterm year, we expected it to be a challenge. We didn't know exactly what the challenge would be, but it looks like it's higher energy prices and some of the geopolitical risks out there. Regardless, as an investor, expect more volatility here into the summer, maybe into the fall, before the uptrend really resumes later on this year. Now, big picture from a secular perspective is we do think that some secular trends might be shifting, and we want to try to align with those long-term secular trends. A couple of those, for example, are international stocks and smaller and mid-cap shares here in the US. So that's what we have for you this week. And as always, I want to thank you for listening and wish you a great week ahead.